We continue our discussion on Chapter 8. To remind us, last class period we were examining an inventory cost flow situation where we had beginning inventory, purchases, and then sales. Notice the units that we had available for sale were a total of 11,000. We had a situation where we had unit costs that were rising over the period, and then we had sales that took place in a total of 6,500, implying that our cost of goods sold was 6,500 in terms of units and an ending inventory of 4,500. What we need to do is determine what amounts, dollar values to place towards the ending inventory as well as the cost of goods sold. And in order to do that, we know that we have to adopt a cost flow assumption. In prior class periods, we looked at specific identification, FIFO, and weighted average. During this class period, we'll start our conversation about Lifo. Lifo stands for last in and first out. This right here looks like an error. It should be Lifo with an L. And we're first going to look at this using the periodic inventory method. Remember, the difference between the periodic and perpetual inventory method in terms of calculation is that the periodic inventory method assumes that all purchases happen before all sales. So when calculating this, we assume that the last good in, and remember, Lifo describes last in, first out, which is a description of the cost of goods sold. So for Lifo, we assume the last good in was the last purchase that took place over the entire year when doing the periodic inventory method, because all purchases happen before all sales. That's not the way we organize the information when we look at the perpetual method. So here we have a description of cost of goods sold. Remember, cost of goods sold for units was 6,500 units. To calculate the cost of goods sold, we start with the last good that was purchased. So if we go up here to our original information here, last good that was purchased here was October 15th. Before that, it was March 22nd. So notice this covers 3,000 and 3,000, a total of 6,000. This means that we need an extra 500 from this bucket in order to produce the total of 6,500, which is the units sold. And so we use the cost that we have associated with each one of those. Again, we pull those costs right here, the $6, $7, and $7.50. And this produces for us 46,500. This represents our cost of goods sold. Here we have ending inventory. For ending inventory, it will be the first goods that came in. These were the ones that remain on hand. And so there we could come up with an acronym if we want. Again, I tried to refrain from giving you too many acronyms to memorize. Remember, the LIFO reminds us for cost of goods sold purposes. The acronym is describing what's sold. If we wanted an acronym for ending inventory, we could use FIST, which is first in, still there, to describe our ending inventory, which we have right here. These 4,000 units, notice, come from beginning inventory, and then the additional 500 from that 1,000 that we did not use for cost of goods sold. That's where we get these amounts for ending inventory. So this is LIFO under the periodic inventory method. Let's look at how it differs under the perpetual inventory method. For the perpetual inventory method, notice that Lifo has to track chronologically what has been coming in and what has been sold. If we consider Lifo to be last in, first out, and we're using a perpetual inventory method, remember that the last good in depends on when we're actually having the sale. That's why we have to organize everything chronologically. So the first thing that happens is beginning inventory, but the next item that happens is a sale. And you can see that from the beginning information we have right here. January 10th is the next thing that happens chronologically. So Lifo, in that instance, the last good to come in that's considered sold is actually from beginning inventory. Remember, that's not the case over here when we use periodic. Remember that all of beginning inventory stayed as ending inventory when we use the periodic inventory method under Lifo. Here we can see, obviously, we are selling, or at least considering that goods that were sold were assumed to be beginning inventory. So the last good that came in for that first sale is going to be beginning inventory. Then we had purchases that take place. These are the next things chronologically that happen. You can see those with the dates right here. Then the next item that happens is another sale of April 15th. And so the last good that came in there at this point is March 22nd. So then we move on to October 15th, which is the next thing that happens chronologically. And then we have finally another sale on November 20th. The last item that came in on that point right here was these 3,000 that we purchased from October 15th. So notice that our ending inventory here, when we use the perpetual inventory method under LIFO, is 27,500. That is different than what we calculated for the periodic inventory method, and it is because we have to organize the items chronologically. Obviously, if there's a difference in ending inventory, there will be a difference then in cost of goods sold as well. If we were to sum these up, right here, we would get 44,000, and that is definitely different than what we had for cost of goods sold over here under the periodic inventory method as well. In comparing these cost flow assumptions, notice that all of them have the same in terms of total for their distribution of cost of goods available for sale. But their cost of goods sold and their ending inventory vary greatly. In a period of rising prices, which if we look over here, we did have a period of rising prices. We started at 550, then we went to 6, then to 7, then to 750. In a period of rising prices, LIFO is going to produce the highest cost of goods sold, and FIFO is going to produce the lowest. Notice that weighted average is going to be right there in the middle. And then ending inventory, same sort of situation here. Ending inventory is going to be the lowest under LIFO because cost of goods sold is the highest, and it's going to be the highest under FIFO because cost of goods sold is the lowest. And then you have a right in the middle approach here for weighted average. Notice that that would reverse if we were in a period of declining costs. LIFO and FIFO would be just the opposite. In terms of disclosures in the financial statements, remember that all of these methods are permissible under GAAP, but companies must identify in a disclosure note which method is going to be used. And keep in mind that not all methods have to be, you don't have to use the methods uniformly across all inventory items that you have. You can choose between which method is most appropriate for the type of inventory that you have, even within the same company. When making a decision about what inventory method is most appropriate, notice that this decision is not made in isolation for just the inventory cost assumption. Usually we take into consideration all the assumptions, and they're designed in the aggregate to meet a particular objective of what you're trying to illustrate in the financial statements as it relates to the company. So other assumptions that we might take into consideration along with our inventory assumptions are depreciation methods, pension assumptions, and other various professional choices that we have under GAAP rules. Specific factors that may influence our decision about choosing an inventory method include, for instance, physical flow. It's important to note that you don't have to it's not mandatory that you have to use the method that approximates the physical flow, but these methods were initially developed to approximate physical flow, so it makes sense that that will be a consideration that you might consider when determining the appropriate method that works for your company. Other factors include income taxes and net income. Notice that each one of these methods produces a different cost of goods sold. We just indicated that in one of our previous slides. And so because it produces a different cost of goods sold, it obviously impacts net income. Cost of goods sold is a main component for merchandisers, at least for the income statement. And so that will definitely affect net income. It also affects income taxes. Notice that the highest cost of goods sold in a period of rising prices, which we're normally in, is going to be LIFO. Because LIFO has the highest cost of goods sold, it also has the lowest amount of taxes. So you can see that these choices that you make about inventory cost flow assumptions definitely have an impact on both net income and taxes. And as it relates specifically to LIFO, the benefit that it produces the lowest amount of taxes in a period of rising prices comes with a disadvantage as well. FASB requires a LIFO conformity rule, which means that if you use LIFO to measure your taxable income, you also must use LIFO for external financial reporting purposes. So then keep in mind that both of these sort of work together in the sense that if you're producing the lowest amount of taxes because you're using LIFO, you're also producing the lowest amount of net income as it relates to financial reporting purposes because of the LIFO conformity rule, which requires that if you choose LIFO for taxes, you also must use LIFO for financial statement reporting purposes as well.